Very good evening to all of you. Welcome to practical session number 19 for the year 2024 for demand supply trading. Myself, Srijit Kakkar, and today is Sunday, 19th of May 2024. Now, before we move ahead, let's get done with the basic formalities. So make sure you people go through the disclosure, which talks about the representation risk disclosure, risk involved in the market, and also about the copyrights. So today's session is again our practical application of demand supply methodology. So in case you haven't learned the demand supply methodology and you want to learn it, or you have already gone through the theoretical part of it, these sessions are the practical application of how to apply the complete methodology. Now coming back to, in case you don't know the methodology and you wish to learn it, then you can find the link to our courses in the description. Our courses are 100% free courses. They used to be paid courses some time ago, but now we have made them as 100% free courses. You can learn the complete demand supply methodology by accessing those playlist. And again, during the session, if I talk about some videos or if I talk about some documents, all the links will be available in the description. So now you know where to find them. If there are some documents or if there are some videos I'm talking about. All right, so let's get started with today's session. So we don't have anything which is getting carried forward or got triggered, and we need to review it. So whatever got triggered in the past has already been reviewed. So we can straight away start with our analysis for today. So let's get started. All right, just give me a second. Perfect. So whenever we talk about trading, I always say trading has to be a very mechanical and rule-based process. Now, why it should be mechanical and rule-based, I have explained this in a video. The title of that video is How to Start Trading. In case you have not yet watched that video, do ensure you watch it. The link is available in the description. Whatever process I've explained in that video, make sure you follow it. You might have to do it maybe twice or thrice. But there is no bypassing it. Eventually, everyone will have to go through that process. So the sooner you start, the better it is going to be for you. And the more it will help you be a mechanical and rule-based trader versus making your trading decisions based on emotions. So do ensure that you go through that process. Now, like I said, we need to be mechanical and rule-based. So what we need to do is we need to create something which is called as a trade plan. So trade plan is basically a collection of all the steps and all the rules you will be following, from identifying your trade to qualifying your trade to taking your trade to managing your trade. So each and every step that you're doing has to be incorporated into that trade plan. Now, what happens is when you start learning trading or when you start learning a new methodology, it's not very easy to create a trade plan from day one because we are lacking the experience of that particular strategy. So only when you have good enough experience, it becomes easier for us to convert that experience into a mechanical and rule-based process. And to overcome this challenge, what I've done is I have created two documents for you. The first one is called as the trade plan steps. You can also call it as the walkthrough or the flow chart, and it guides us step by step what we need to do as a demand and supply trader. Now, all these steps, they have their own elaborate rules, and those rules are available in the rule book. And this rule book is a conservative approach. Now, different traders, different personality styles. So eventually, as you gain more and more experience, if you want to make some modification to this rule book to make it more conservative or to make it aggressive or to make it super aggressive, that can be done. And that's fair because, like I said, every trader has a different personality style. So it's not that one size will fit all, right? Different people will have different approaches. So that is where those modifications can be done. So coming back to what is my step number one when we start planning our trade. The step number one is we need to define our trade purpose. And what do we mean by trade purpose? Trade purpose implies the expected duration of the trade. And the duration of the trade is from the time you enter the trade to the time you exit the trade. Now, when I'm talking about the exit can be the target, the exit can be break even, the exit can be the trailing stop loss, the exit can also be the stop loss, any kind of exit. So exit does not imply only profit exit, right? Exit can be in profit, exit can be break even, exit can also be in loss. So whatever the exit might be, whatever I'm expecting my duration of the trade, that is what we call as the trade purpose. Now, why are we starting with the trade purpose? The reason for that is when we do our analysis, we use technical charts, and those charts are time-based charts, and we have a number of time frames available to us. So the very first challenge we face is that out of these n number of time frames, which time frame should I be using for my analysis? That's the very first challenge. And to overcome this challenge, we do not start by randomly selecting any time frames. We start by first defining our trade purpose, because logically, the longer I want to be in the trade, the bigger the time frame I should be using for my analysis. And similarly, the smaller I want the duration for the trade, the smaller the time frame I should be using for my analysis. So that is the reason, to help us define what time frames I should be using, I will first define my trade purpose. Now, what I've done is I have divided these trades into four different purposes. We call them as hourly income, daily income, weekly income, monthly income. Hourly income implies a trade where my expectation is that this trade can last for an hour or maybe few hours. Daily income, a trade which can last for a day or few days. Weekly income, a trade which can last for a week or few weeks. And monthly income, a trade which can last for a month or few months. Now, by definition, I definitely say daily income is a trade which can last for a day or few days. But the challenge here is, if you're talking about, let's say, the NSE market, it's not a 24 hours market. So I'm pretty sure all of you would have experienced that whenever the market opens, some stocks they gap up, some stocks they gap down. So whenever you're trading markets which are not 24 hours, I'm pretty sure all of you would have experienced, the very next day, these prices they're gapping up or gapping down. Now, because of this gap up, gap down, what can happen is, if you get a gap in your favor, you might get profit which is bigger than what you were expecting on that trade. But in case you get a gap against you, you can also lose more than what you were willing to lose on that trade. And that is why my recommendation to all of you is that initially, as a risk management rule, we will not do daily incomes as overnight trades. Initially, our hourly dailies are strictly intraday trades. Weekly monthlies, anyhow, we are not anticipating to get the exit the same day. So here you have no choice. You'll have to keep these positions as overnight positions. But that does not imply that for weekly monthlies, you cannot have gap against you. It can happen. But since we are leaning against some bigger time frames, the probability definitely reduces. So again, initially hourly daily is intraday, weekly monthly is overnight. With time, with experience, if you want to include daily incomes into overnight trades, it can be done. It's just that initially we are trying to avoid that as a risk management rule, to take care that we do not lose more than what we are willing to lose, just in case we have a gap against us. So my step one is, I need to define my trade purpose, and let's assume I opted I want to plan monthly income trades. Now, once I have selected my purpose of trade, what is going to happen? From the rule book, I'll get to know what time frames I should be using. So if you go to page number 28 in the rule book, we start with the multiple time frame analysis. Now, demand supply methodology is not based on single time frame, it is based on multiple time frame analysis. So what are the multiple time frames we use? We use a minimum of 4 different time frames, and we call them as the higher time frame HTF, intermediate time frame ITF, lower time frame LTF, and the refining time frame RTF. Higher time frame is used for demand supply curve analysis. Intermediate is used for trend analysis. On the lower time frame, we identify areas of demand and supplies for our entries and exits. And the refining time frame can be used for multiple purposes, like fine-tuning the zone, different kind of entries like your type 2 type 3 entries, or in case we need to apply some additional rules, that is also where this time frame can help us. Next, what are the 4 different trade purposes? We have already talked about it. What is HIT, DIT, WIT, and MIT? So now the question comes that for every purpose of trade, what will be my 4 different time frames? And you can see for the NSE market, you have it on page number 31. And if you're trading markets which are open for longer durations, like you have your commodities, forex, cryptos, then you can refer to this table. Since we are taking example from NSE, I'll be referring to this table. And here you can see this table tells me that if I'm planning to go for a monthly income trade, then my time frames will be monthly, weekly, daily, and 60, wherein monthly will be the higher time frame, which is used for curve analysis. Intermediate will be weekly, which is used for trend analysis. Lower time frame will be daily. That is where we get our SCTS from. SCTS stands for stop loss, entry, target, and size. And in case I need to use the refining time frame, then my refining time frame will be the 60 minutes chart, which can be used for multiple purposes like fine tuning the zone, type 2 type 3 entries, or in case I need to apply some additional rules, that is also where this time frame can help me. So as soon as I'm done with my step number 1, now I have the clarity to what time frames I'll be using, plus what is going to be the purpose of each and every time frame. So my challenge number 1 is taken care. Now comes challenge number 2, and that challenge number 2 is that yes, I do know my time frames, but the problem is, if you talk about, let's say, the NSE market, we have over 2000 plus companies listed on the exchange. So humanly not possible that I sit and analyze 2000 companies every day. So step 2 is to have a process in place for selecting scripts, that out of these 2000 companies, I need to get a smaller list, because if you have a small list, you can do your analysis almost every other day. But if you have to sit and analyze 2000 companies every day, it's a task, and I'm pretty sure nobody would want to do that. So how do we do this? For this, we use certain computer programs which are called as scanners or screeners. And the way these scanner screeners, they basically work is that we input certain conditions into them, that these are the conditions I'm looking for. And then that scanner screener identifies that out of these 2000 plus companies, which companies are matching with those conditions. Whatever is matching with those conditions, it gets shortlisted for us, and that is how we get a smaller list. Now, something which is very, very important, and you always have to remember, no matter what scanner or screener you're using, whatever results you get from these scanner screeners, they can never be blindly bought or sold. So the scanner or screener never tells you what you need to buy or sell. The job of the scanner screener is from a bigger list to give you a small list. Now, once you have that small list, you will have to analyze them manually and see which one matches with your trade plan. Whatever matches with your trade plan can be your opportunity. Whatever doesn't match with your trade plan, you simply skip it. Now, a few examples of these scanner screeners. Example one, if you go to my website, you will see under the free tab, I have created a scanner for you, which is based on some moving averages and can help you shortlist symbols. Second example, on my YouTube channel, if you search for scanner, you'll be able to find a few videos, different scanners, different logics. You like any of those, you can use that. Third example, on my YouTube channel, search for sector analysis. You'll be able to find a video on sector analysis, which can again help you in shortlisting symbols. Fourth example, on my YouTube channel, search for top-down analysis. You'll also be able to find a video on this, which can again help you in shortlisting symbols. So these are 3-4 different examples, but you're not restricted only to these 3-4 different scanner screeners. Let's look at few examples before we move ahead. So like I said, once you go to our website, under the free tab, you can see you have stock screener. Because I want to plan MIT trades, I can run the long scan and the short scan. So here you can see the long scan is shortlisting 2 symbols for me, and the short scan is shortlisting 1 symbol for me. So like I already said, just because these 2 symbols are getting shortlisted as a long scan does not mean I can blindly buy these 2. Similarly, just because I'm getting this symbol as a short scan does not mean I can blindly sell it. So again, the job of the scanner is not to tell me what I need to buy or sell. The job of the scanner is to help me get a smaller list. And now you saw that it gave me a list of only 3 symbols out of 2000. So what I need to do is I need to analyze these 3. If any one out of these 3 matches with my trade plan, I have an opportunity. If nothing matches with my trade plan, nothing is available. Now, many times what can happen is your list can be very small list, like you can see today, or maybe at times no results are getting generated because maybe nothing is matching with these conditions. Or even otherwise, if you want that my list should always be a little bigger list, because if I have a bigger list, the probability of finding some quality opportunity increases. So in such case, what you can do is you can see I have given 5 different conditions. Disable the third one in the scanner and run the scan again, and I'll do exactly the same thing here. I'll disable the third one, run the scan again. And now you can see that initially it was shortlisting 2 symbols for me, but now it is shortlisting 47 symbols for me. And similarly, if I go to the short scan, instead of 1, now it is shortlisting 22. So we have 47 plus 22, which is 69 symbols to look into. So it's not that you have a list of 500 or 600 symbols to look into. It's still a very small list, about 69, which can, I'll say, easily be analyzed in about half an hour, 45 minutes. Now, if you feel that the list is still big and you further want to filter it out, you can use different filters. Example, I can say, I only want the ones which also get traded in futures. I'll also do the same thing here. The one gets traded in futures. And now you can see I have a list of 14 plus how many? 14 plus 11, which is 25. So you can make this list a little bigger. You can make it a little smaller by using different filters. And again, this is not the only screener that is available to you. If you go to the screener section on this website, you can see you have over 150,000 scanners available to you. And out of these, some are based on fundamental analysis. Then you have your top loved. Then you have your candlestick patterns. Then you have scanners based on range breakouts. Then you have your bullish scan. You have your bearish scan. Then you have intraday bearish, intraday bullish, crossovers. So a number of scanner screeners available to you. Out of this, whatever you feel is the right fit for you, you can use that to help you get a smaller list. Now, in this example, you saw that we got a list of about 69 symbols. Now, once you start analyzing them, few challenges you will face. Challenge number 1, what you will realize is that majority of the symbols in this list, they do not have a quality demand area or a quality supply area on the lower time frame. And the reason for that is because all these scanner screeners are either based on conventional technical analysis or fundamental analysis. They have nothing to do with demand supply zones. So just because something is getting shortlisted does not guarantee that you'll have a quality zone available on that particular symbol. The second challenge is that some of these scripts which might have quality areas, those areas might be far away from the current market price, due to which you'll have a longer waiting period before prices are back to your zone. And during that waiting period, what can happen is wherever price action develops, it might disqualify the trade setup by the time it is back into your zone. So these are some of the challenges we face when we are using screeners, which are either based on conventional technical analysis or fundamental analysis. And to overcome these challenges, I've also created two custom built tools. One is the alert service, the other one is the demand supply screener. Again, I'll add, these are not call giving or tip giving services. These are again scanner screeners, but the only difference is that these two scanner screeners are purely based on demand supply zones. So let's look at their examples as well. Now, I'll add here that in the description, you'll be able to find the walkthrough videos for both of them, alerts and screener, which will give you more information about them. For alerts, we also have the demo channel. We have the demo channel for NSE. We have the demo channel for Forex. We also have the demo channel for MCX. So if you want, you can join that demo channel to experience it. So here I'm showing you example from the demo channel. So what happens is on the demo channel, we give you for half an hour alerts live. So for the NSE, we give you alerts from 11:15 to 11:45 Indian Standard Time. So here you can see for 18th, on 18th, we had that special trading session on Saturday. So you can see as and when the zones are getting formed. At 11:15, a zone got formed on 5 minutes chart. Again, you can see we have an alert on 11:15 for the daily time frame. Then we have for the 15 minutes time frame. Then at 11:30, we again have for 15 minutes. Then at 11:35, we have for 5 minutes. Then 11:45, we again have for 15 minutes. So what you can see here is that as and when these demand and supply zones are getting formed, we immediately get the notification because these notifications are live, and it's not telling you that this is where you can buy or sell. It is only telling you that on this particular script, on this time frame, we have a formation of a quality demand area or a quality supply area. Now what you need to do is when you get these notifications, you'll have to match these zones with your trade plan. If they qualify as per your trade plan, they might be your opportunities. If they don't qualify, you'll simply skip them. So again, the job of the scanner is never to tell you what you need to buy or sell. It only helps you get a smaller list, and here you can see it is doing it purely based on formation of demand and supply areas in real time as and when they are getting formed. Similarly, we have another tool which is called as screener. So here you can see in the screener, I've given a list of about 40 symbols. And then I've told the screener that out of these 40 symbols, identify the symbols where the current candle is within 1% proximity to a demand area or a supply area. So now what is going to happen is from these 40 symbols, can you see it is throwing me a result of 4 symbols, 2 are close to demand, 2 are close to supply. So I don't have to analyze 40 symbols. I just got 4 which I can analyze. And similarly, you can have a multiple chart layout, or you can have multiple layouts, and you can apply the screener a number of times to scan as many symbols as you wish to. So just as an example, if I go to Nestle India, you will see that will be closer to a demand area. That is what is highlighted, that we are closer to demand. And let's wait for a few seconds. You can see we have this demand area. We are close to it. Similarly, if I go to Infi, we'll again be closer to demand area because that is what is highlighted. So let's wait for a few seconds, and you can see we have our demand area here. We are pretty close to it. Similarly, if I go to ITC, now you will see that we will be close to a supply zone, because that is what it is telling us. ITC, we are closer to supply, and here you can see we have this rally base drop and we are pretty close to it. So this is what basically scanner does for us. It helps us identify symbols based on the proximity to the demand zone or proximity to the supply zone. So the difference between the two is alerts are based on the zones which are getting formed during that current day, right? But screener is based on proximity to the zone, be that zone was formed today or a week ago or a month ago or a year ago or a decade ago, right? So here it takes care of everything from today to whatever history is, but alerts are purely based on the current day. Again, I'll add, these are not mandatory tools. These are all optional tools. I've just shown you a number of ways for shortlisting symbols. I showed you some free scanners. I showed you scanners which are subscription based, and the process can also be as simple as, I don't want to use any of these scanner screeners because I want a small list. I will only be analyzing my Nifty 50 stocks, or maybe I have my own favorite list of stocks which I want to analyze every day. So choice is yours how you want to shortlist it. But once you have that list, now you have everything ready to start start ahead and start doing your analysis. So from the first step, we got to know our time frames, which was monthly, weekly, daily, and 60. And now we know the symbols we need to analyze. So we have to analyze these symbols one by one by using these time frames. And whatever will match with my trade plan might be the trading opportunity. Whatever doesn't match, we simply skip it. So the next step is to start from the lower time frame. So here the question is, what is my lower time frame? We got the answer from our step number 1. As a monthly income trader, my lower time frame is the daily chart. So we'll go to daily. And on the daily time frame, we need to identify zone. By zone, we mean any of these four structures. It can be a drop-based rally, rally-based rally, rally-based drop, or a drop-based drop. So let's go to our chart. Now, what I'll do is, for a minute, I'll hide the indicator. Now, whenever we talk about demand supply methodology, always say it's a price action based methodology. And by price action, we mean the action done by the price. And what action can price do? Only two things. It can either move up or move down. It cannot do anything else. But when price is moving in a narrow range, we call it as the period of pause, or we can also call it as our basing. Now, initially, when we start learning demand supply methodology, our eyes are not trained to identify these structures. So that is the time we start with a mechanical process, which is boring, exciting candles, which helps us, train our eyes to how to identify these zones. But keep it at the back of your mind that every zone will not be in sync with boring, exciting technique, right? Most of the zones, yes, will be in sync with boring, exciting, but not every zone. So that is why it is a good starting point to start training your eyes. And the best part is that the boring candle indicator is an absolutely free indicator. If you search the indicator section on TradingView boring candle, you'll be able to find the indicator by me, which is Surjit Kakkar, and you can use that indicator for free forever. Similarly, we have the explosive move indicator, which you can again use for free forever. So these two indicators can initially help you in training your eyes to identify zones on the chart. And along with that, we also have another indicator which is called as demand supply zone indicator. And this is much more advanced because it's not based on price. It is not based on boring, exciting technique. It is based on purely price action. And here you can see, as soon as I apply the indicator to the chart, now I don't have to identify the zones. The indicator automatically identifies the zone and plots the zones for me. And we also have the demo version of demand supply zone indicator available. So again, if you go to the indicator section on TradingView and search for demo demand supply zone indicator, you'll be able to find it. And again, you can use it for free as long as you wish. The only restriction for the demo indicator is that it will only work on the daily time frame. You'll not be able to use it on any other time frame, right? So that's the only restriction. But otherwise, on the daily time frame, all the functionalities will work. So if you want to try it out, you can even do that. So here you can see, as soon as I applied the indicator, it is telling me that we have a drop based rally zone available to us. So let's draw this zone. So now I don't have to identify the zone. You can see the indicator is doing it for me automatically. And let's change this to demand. So yes, my step number 3 was to identify a zone on the chart. Do we have a zone available? The answer is yes. Now, this is where traders, when they start learning demand supply methodology, initially they make the biggest mistake. And that biggest mistake is they find any demand area on the chart, blindly start buying. They find any supply area on the chart, blindly start selling on that supply, which is incorrect. Once the zone has been identified, the next step is to qualify it. And for qualification, we have a 2-step process. In step 1, we'll do it based on certain conditions. And in step 2, we'll do it based on the booster scoring. So let's see what these steps are. So the first thing we'll check is that is the zone a case of level on top of level? Now, how do we verify that? It's a very simple concept. If you have an intermediate time frame zone and the same intermediate time frame zone divides into multiple zones on the lower time frame. So when your intermediate time frame zone divides into multiple zones on the lower time frame, we call it as a case of level on top of level. So what we understand here is that to be a case of level on top of level, my lower time frame zone has to be inside the intermediate time frame zone. Because if it is coinciding, the possibility is it might be a case of level on top of level, but if it is not coinciding, it cannot be a case of level on top of level. So let's verify that the zone that I have identified, does it coincide with any intermediate time frame zone? Now, as a monthly income trader, my intermediate time frame zone is weekly. And if I draw this weekly zone here, you can see we do have a drop based rally weekly zone. So let's draw this. And what I'll do is I'll change the color to pink so that we can differentiate between the two. Now, the one marked in pink is my intermediate time frame zone, and the one marked in green is my lower time frame zone. So is my lower time frame zone inside my intermediate time frame zone? The answer is yes, and that is what we call as a coinciding level. So it is definitely a coinciding level. But now to check whether it is a case of level on top of level or not, what we need to do is we need to check, do we have one zone or do we have multiple zones? Now remember, when it comes to cases of level on top of level, it is not mandatory that the other zone might be a quality zone. And here you can see by default the indicator is identifying quality zones for us on the lower time frame. So I can change the setting that now I don't want quality zones, I want all demand supply zone structures. So as soon as I check mark this, you can see it is identifying now many more demand and supply areas for us. And now what you can see is exactly what we were talking about, that you have an intermediate time frame zone, and the same zone got divided into multiple zones on the lower time frame, and that is what we call as a case of level on top of level. So let me zoom in a little bit so that you people can see it much more clearly. So here you can see this, the one marked in pink is your intermediate time frame zone. Let me mark it again. So this was the intermediate zone, which is getting divided into multiple zones on the lower time frame, thereby making it as a case of level on top of level. Now, in this case, what I did was, in fact, if you have been going through these practical sessions, you would have seen that what I generally do is whenever I see such a case, I always push my distal line below the distal of the intermediate. In fact, here what makes more sense is because it is a case of level on top of level, I can ideally shift to the lower zone. But I actually did not do it. I combined both the areas. Now, why did I combine both the areas? We'll talk about it as if, as we move forward. So this is one modification I'll do. I'll not shift to the lower zone. I'll combine both the zones together to take the advantage of case of level on top of level as well. But why did I do that? As we move ahead, we'll talk about it. So yes, it is a case of level on top of level. Now the next question is this zone because of a gap? And the answer is yes. So here you can see that we came down, we paused for a while, and after that we have a gap up from here. And that is the reason why I wanted to combine with this area, because if I just go for the lower one, what might happen is prices might fill this gap and start reacting from there, and due to which I might miss my trade. But if I have this included, then there is a higher probability of getting a fill, which is basically now this weekly zone that I'm trying to trade. Can you see I've taken the complete weekly zone? Yes, if you want to fine tune your proximal line a little bit, you do have two options. Option one can be you can go the body to wick method, or you can also have your proximal line from wherever the prices they gapped up. But I'll combine both the levels together using wick to wick method. Now, whenever you have a zone which is because of a gap, now this is our session number 19th, and I guess this is the very first session where we are taking example of a gap. And that is the reason I always keep telling you that be regular with these sessions. If you can't join live, at least watch the recordings later, because every session will have something new to learn from. But yes, once you have gone through enough sessions, what I'll say is probably once you have gone through maybe 50-60 sessions, then it will be repetitive. The same thing will be getting repeated over and over again, and then you'll start getting bored with it, and that is when you'll realize, okay, now you know the complete methodology because you have understood everything. So unless you reach that point where you start getting bored of these sessions, you should be attending these sessions regularly to understand all these concepts. All right, so coming back to when you see a gap, now how do we qualify a gap? If you go to the gap rules in the rule book, you will see that the rules, they tell us whenever you're using gap as a demand or a supply zone, the first thing you need to ensure is that it is an overnight gap. Now, what do we mean by overnight gap? That we closed at a particular price on a particular day, and the next day we opened at a different price, which can be a gap up or a gap down. But if that gap is during live market, then that gap has no meaning for us. Why? Because the gaps that you see in the live market are only because of lack of liquidity, because the spreads are bigger. And if you have a bigger spread, because of transactions happening at different price points, we might be gapping up or gapping down. But those gaps, they do not show us imbalance between demand and supply, because that's only due to lack of liquidity. Now, these gaps that we see as overnight gaps, the only reason here is because during the pre-market, somebody during the pre-market was willing to buy at an expensive price, and that is the only reason for prices to gap up, and that shows us imbalance between demand and supply. So yes, that's our rule number one. It has to be an overnight gap. This was definitely an overnight gap, and it also has to be an open gap. Now, what do we mean by an open gap? So let's assume that we closed at 100 and the next day we opened at 101. So now we have a gap from 100 to 101. So unless and until prices they go back to 100, this will remain as an open gap. And why do we want an open gap? Because if it is an open gap, it is still a fresh area. If the gap has already been filled, then it is a tested area. So our condition number one is definitely satisfied. It is an open gap, and it is also an overnight gap. So condition number one taken care. Next, it also has to be a pro gap. And to identify whether it is a pro gap or a novice gap, we'll be using the daily chart. That is what you always have to do. Now, what do we mean by a pro gap? The definition is already given: a gap in the opposite direction of the price. So if I go back to the chart, you can see that the dominant direction before we got that gap, you can see this is where we gapped up. And before that, the dominant direction was we were moving down, and then we had a gap to the upside. Now, if you think about it, something which was at certain price has already become really, really cheap. And now we are gapping up, which means maybe somebody was willing to buy a little expensive to get a bigger fill. And that is what shows as a professional action, that at a cheaper price, somebody wanted to buy a little expensive to get a bigger fill. So yes, this definitely shows us a pro gap. So going back to the rules, this was an open gap. This is a overnight gap, and this is also a pro gap. So all the conditions are applicable. Now this stock is not making all-time highs or all-time lows, so this rule is not applicable. But the other two rules which we need to apply are applicable, and based on those rules, this zone is definitely qualified for us. Now next is pivot and non-authentic. Now this zone is definitely a drop-based rally structure to which we always apply pivot and non-authentic rules. But here we can skip it, and why we can skip it is because I have given you this as a rule in the rule book, that whenever we have reversal structures which we call as pivot and non-authentic, we try to add some positive factor, and being a pro gap is already giving us that extra probability that we are looking for. So in case of pro gap, you can definitely skip the rules of pivot non-authenticity. So this is not applicable and not a structure of unstable equilibrium. So after applying all the applicable rules, is the zone qualified? The answer is yes, the zone is qualified for us. Next, what we'll do is, just because it is qualified does not imply we can still trade it blindly. Next thing is we need to understand its quality and the probability factor. Now let me just change these settings back to my default, and let's also mark the zone. So it's starting from here. This is where it ends, and coming back to the proximal line. Alright, so starting with the very first one, freshness. The zone is fresh, gets a score of 3. Strength, we have a gap, which always gets a score of 2. Time at the zone, 3 candles in the basing, gets a score of 2. Reward to risk ratio, we are taking as an assumption. Now, you might say that we do have a zone sitting right above, so why are we taking it as an assumption? Because you never know, right? Tomorrow, in fact, tomorrow the markets are off. On Tuesday, prices might test the zone and then come back, which means this is no longer the target for us. So that is why I'm taking it as an assumption as of now, even though we can see that we have a zone which is showing us less than which is showing us less than 1:1. So as of now, the reward to risk ratio is not really nice. But if this gets tested, then our reward to risk ratio will be really nice, because you can see after that, the very next fresh zone is somewhere around here, which is showing us about 5:1. So we ideally want this to get tested and then the prices come into our zone, so that our reward to risk ratio is good. But if that does not happen, then this trade has to be skipped just because of bad reward to risk ratio. All right, now coming back to location, if I go to the monthly time frame, here you can see that we do have areas of demand, but we don't have any supply areas. So we have taken such cases a number of times in the past. So what we do here is two options. If you're a very conservative trader, skip this symbol, move to a different symbol. But as an aggressive trader, we understand that if the prices have moved down from here, the only reason is there has to be some supply. It's just that that particular supply is not visible on the monthly time frame, but it might be visible on some other time frame. So I can take this pivot high as my reference point and draw my curve. And now you can see we are planning our trade low on the curve. So we are planning our trade low on the curve, which gets a score of 1. Now talking about the trend, here you can see that the indicator is telling us that we have one supply violation, one demand violation, which makes it as sideways, and sideways will get a score of 0.5. Move from the zone, we need minimum 4:1, which has already happened. In fact, we probably have 10:1 or maybe 12:1 kind of a move, therefore gets a score of 2. It is a case of level on top of level. It is also a coinciding level. Now, the fact is we can simply skip the trap, because no matter whether we get a score of 0 or we get a score of 1, it will still remain as a type 1 trade for us. But here we can give it a score of 1, and the reason for that is if I take a horizontal line wherever the proximal is and start pushing it up, you can see that this area has been acting like support, right? Here again, almost support, acting like resistance, acting like almost resistance, resistance again acting like support. Here we did have some whipsaws, but here again it has acted like support as of now. So we do have a very clean area of support and resistance, and now we have our zone sitting right below it, which can make this zone work like an area of trap, because people who took long trade, they'll be having their stop losses, which is sell orders, placed below it. And similarly, if you have a breakout traders will also start selling. So by the time we are into this zone, we'll have a lot of selling coming in, and these people are making two novice mistakes: selling after a decline in price, and in an area where the chart has proven to us back in history demand exceeded supply, which could be the only reason for prices to move up. So yes, that possibility is there, for which we will give it a score of 1. So we have a score of 10 out of 10 for quality with the assumption of reward to risk ratio, and 6.5 out of 8 for probability, which makes it as a high quality, high probability trade setup. And high quality, high probability can be traded as type 1 trade. So after applying the boosters, we got to know that this can be done as a type 1 trade. Now, no matter how high the quality or the probability, any trade can be a stopped out trade. So we need to be ready for the worst case scenario, where we will do our position size calculation. Now, whenever the prices are back, we'll have to re-verify, because markets are not static, markets are dynamic. Conditions are changing almost every other second. So we'll have to re-verify, does it still qualify based on my trade plan when the prices are about to enter the zone? If the answer is yes, then we place our order based on the entry type, in this case a type 1 trade. And once your order has been executed, the last step is your trade management, where first step we do is 1:1, we make it as a break-even trade, and after that, if we get the opportunity to trail onto it, we start using our trailing stop loss. So this is how we plan trade, very mechanically, very rule-based, and that takes care of today's example, which was an example of gap. And I guess that's the very first example we have taken as a gap example in the last 19 sessions. In fact, I guess we have 19 sessions from this year and 2 sessions from the previous year. So out of 21 sessions, I'll say that's the very first example of a gap. So again, that's your practical session on gaps and how to use zones which are based on gaps, how to qualify them. Now I'll look into the chat box and answer some of your queries. But before I do that, I'll definitely add, if you're not subscribed to my channel, make sure you do that, because one, generally these sessions are predefined that on this particular day, this time is when I'll take my session, but at times I'm not available and these sessions might get rescheduled. So if you're subscribed to my channel, once these sessions are rescheduled, you'll get the notifications for it. If you're available, you can join it live. Otherwise, later you can watch the recordings. Plus, if you're liking these sessions, do hit the thumbs up button. And if you have some friends or family members who are into trading, or if you're into some trading group, you can definitely share the link to my course videos and to these sessions, so that people can take advantage of it. So let's see what do we have in the chat box. So the very first question is, if I want to swing trade, at what time I should use for entry? Please explain when you are taking. Okay, so again, see, when you're talking about swing trading, your WITs can be considered as swing trading. Right now, depending upon what markets you are looking into, you can choose your time frames based on that. So if I go to page number 32, I guess. Yep. So if I go to page number 32, so if you're looking at markets which are open for longer durations, then you can use these time frames, which is weekly, daily, 240 and 60. Weekly will be the higher time frame, daily will be intermediate, lower time frame will be 240, and refining time frame can be used as 60 minutes. So that's the time frames you can look into for your swing trading. All right, next is so your course fee. Now, if you're talking about the demand supply methodology course, it used to be a paid course some time back, but now it is an absolutely free course. You can learn the complete methodology absolutely for free, and the links are available in the description. The same videos which you'll be going through were first part of our paid course. So again, you don't have to pay anything. My courses are now available absolutely free of cost. All right, so in case of open gap, should we consider that zone or not? In booster Excel, there is no score to gap. Can you please explain what we do in case of open gap? Not clearly explained in demand supply. So again, today we took an example of gap, and now I'm pretty sure you might be having a little better understanding what we need to do. Now, if you talk about the booster scoring, I think in the smart Excel sheet, you should have that option where if you select gap, by default it will give a score of 2. Otherwise, if you think about it, a gap is as good as an explosive move. That's the biggest imbalance you can see when it comes to understanding the imbalance between demand and supply, because like I was talking about, a gap up or a gap down basically implies that during the pre-market somebody was willing to buy expensive or somebody was willing to sell cheap, which shows us the biggest imbalance between demand and supply. Alright, so drop-based rallies on refining time frame. Why alert send signal on rally-based drop in daily chart? That is, uh, See again, when you are getting the alerts are based on the lower time frame. So we are basically, now if you talk about the NSC, right? On NSC we give you alerts for 5 minutes, 15 minutes, 60 minutes, and your daily. So your 5 minutes alerts are for the HITs, your 15 minutes alert are for the DITs, 60 minutes alerts are for the WITs, and the daily alerts are for the MITs, right? So they are independent, they are not correlated to each other. So it's not that if you're getting an alert on a 5 minutes chart, that is the refining time frame for, let's say, DIT trade, right? So this is independent, this is independent, this is independent, this is independent. So they are not related to each other in any ways. All right, so that I hope clears the confusion. Question with you here is comment section, no option to upload videos. See, the problem is it's not just you from whom I'm getting the emails. Every day I get hundreds of emails. Therefore, it is not possible for me to reply to each and every one of them. And that is why this is what we have chosen as the way to reply to your queries. Now you can see if your queries are posted here, I'm definitely answering them. I do understand there is a limitation, which is you can't share your screenshots. But if you just try to explain your query without the screenshot, I'll still be answering it. But yes, you have to understand that for me, it is humanly not possible to reply to emails because of the kind of volumes we get. It's definitely not possible, right? So I apologize for that, but it's not that they're doing it on purpose. It's just that for me, it is not possible to answer so many queries every day. So that is why. And again, see, even if I try to do that, the other challenge is, explaining something in a live environment is much more easier versus explaining it in text. Right now, what I can do is, if there was something I had to explain, like somebody was asking about an open gap, right? I can easily show you on the chart, okay, this is what we call as an open gap. But if I have to do the same thing on an email via text, it will be much more challenging and time consuming. So again, I'll say I'll apologize for that. But it's just because of the volumes of emails we get, it's not possible for me to reply to each and every one of them. But I'm pretty sure you would have definitely got a reply to your email that you can put your query into the chat box during the live session, and that is where I definitely try to answer all the queries I get. Now, even if you're not watching this session live and later you're watching the recording, you can still put your question in the Q&A tab. In the comment section. I try to answer all the questions that I get in the comment section. Yes, at times they might be a little delayed, but I try my best to answer them as well. Alright, so you are the best mentor the internet can ask for. Alright, so thank you so much. Happy to know that this is helping you. Probably that is the reason you're calling me as a good mentor. But again, it's your hard work. You people are going through these sessions, you people are applying it, so it's all about your hard work. But yes, I again thank you for your comment. I appreciate that, so thank you so much. Please make a video in Hindi. So we already have a Hindi session. So this channel is the English channel. We have a Hindi channel as well, where we do the exact same thing in Hindi. So numerology and Vastu, if you're interested in Hindi, you can join the other channel, which is called as Trading Munch, and that is where I do the sessions in Hindi. All right, so that brings us to the end of today's session. I'll be seeing you now the next weekend. Till then, trade safe, enjoy your Sunday evening. Take care. Bye bye.